Good morning, good afternoon, folks. Greg Silverman here from CIOs and Bow Ties. Another session of Come Learn With Me. We take the articles that everyone liked from last week, and then we'll just go through them together. We'll talk about them and read them off and highlight points. So it should be interesting. The news cycle my news cycle, let's put it this way, is being dominated by SPACs right now. This is one of two articles that percolated to the top. So let's have a read. Come join with me. SPAC transactions come to a halt amid SEC crackdown, cooling retail investor interest. After a record 109 new SPAC deals in March alone, issuance has now come to almost standstill with just 10 SPACs in April, according to data from SPAC Research. The SEC issued accounting guidance that will classify SPAC warrants as liabilities instead of equity instruments. CNBC give you all the bullet points up front. Bank of America client flows show that retail SPAC buying slowed down significantly. The proprietary CNBC SPAC post-deal index has wiped out 2021 gains and fallen more than 20% year to date. All right. SPCX, I guess is a ticker ETF. SPAC mania has come to a screeching halt. Just last month, special purpose acquisition companies celebrated a head-turning milestone by breaking their 2020 issuance record in just 3 months' time. After more than 100 new deals in March alone, issuance is nearly at a standstill with just 10 SPACs in April, according to data from SPAC Research. The number of new SPAC IPOs per month, March 109. The drastic slowdown came after the Securities and Exchange Commission issued accounting guidance that would classify SPAC warrants as liabilities instead of equity instruments. If it becomes law, deals in the pipeline as well as existing SPACs would have to go back and recalculate their financials in 10Ks and 10Qs for the value of warrants each quarter. That's a lot of work. SPAC transactions have essentially come to a halt, says Anthony DeCandido, partner at RSM LLP. This is going to cost these companies a lot of money to evaluate and value those warrants each quarter rather than just do at the start of the SPAC. Many of these groups lack the sophistication internally to do this themselves. SPACs raise capital in the initial public offering and use the cash to merge with a private company and take it public, usually within 2 years. Warrants are a deal sweetener that offers early investors more compensation for their cash. This potential accounting rule change could be a huge blow to the SPAC market, as it could take away the incentives for sponsors and operating companies to opt for this alternative IPO vehicle. Low level of scrutiny and the ability to move quickly. Meanwhile, restating financials could further dent investor confidence in a market that's already highly volatile and oftentimes viewed as speculative. In the accounting world, this is one of the biggest challenges you can face, is if you have completed work and then you have to go back and do it because it just shows poorly to the outside and evokes the level of public trust you really want. The Candido said, it just further scrutinizes what's already been a very misunderstood exit plan in SPACs. To make matters worse, more than 90% of SPACs are audited by just 2 accounting firms over the past 6 years, Marcum and WithumSmith+Brown, according to SPAC Research. Wow, I must be busy. This could mean a significant backlog ahead of SPACs scrambling to adhere to new accounting rules. Here's the SPAC index. Many SPAC stocks are in free fall amid the regulatory hit. The proprietary CNBC SPAC post-deal index, which is comprised of the larger SPACs that have announced a target or those who have already completed a SPAC merger within last years, has wiped out 2021 gains and fallen more than 20% year to date as of Tuesday's close. Signs emerged that retail investors might be having second thoughts about SPACs. Bank of America client flows showed that retail SPAC buying slowed down significantly from 120 million weekly net purchases at the beginning of this year to just single digits in April. I mean, obviously things slow down if you changed the rules midstream. A lot of work would have ceased. Early data from April suggests that retail may be returning back to their traditional roots, favoring more established companies over low-price speculative securities. Bank of America analysts said in a note on Mondays. Clover Health, which merged with Chamath Palihapitiya's social capital Hedosafia Holdings Corp. 3 in January, dropped more than 10% on Tuesday, pushing its 2021 losses to nearly 50%. SPAC Tech, which is taking sports betting company Genius Sports public on Wednesday under former Genie, plunged more than 11% Tuesday. Now, there you have it. We have no, we're not going to make any investment recommendations here, but it's interesting. Join us for some of the other SPAC articles. They're very interesting. It talks about, why SPACs have become popular. Again, I think it goes back to the democratization of the markets. SPACs are a public IPO, publicly listed stock, and that a lot of people want to buy them through Robinhood accounts, I guess. So anyway, fascinating topic. Thanks for joining us. I hope you learned a lot. Come join us again.